Everyone's been pointing fingers at Porsche's EV troubles. Taycan delays, battery headaches, range anxiety. It's become the low-hanging fruit of auto gossip. But here's the thing, that's only half the story. Porsche's real problem isn't sitting in a charging bay. It's buried deep inside the company's sacred money-making machine, and right now, that engine is sputtering. See, for years, Porsche had the golden formula. SUVs like the Cayenne and Macan weren't just bestsellers. They were pure profit vending machines on wheels. You'd think they were printing money in Stuttgart, but lately, those high-margin darlings aren't keeping the cash flowing like they used to. And that's the hidden crisis almost nobody's talking about. So if it's not just EVs dragging Porsche down, what exactly is bleeding them out? Well, that's where things get interesting. Let's start with the numbers, because they set the stage for everything else. And these numbers, they're brutal. In the first half of 2024, Porsche's operating profit didn't just dip, it tanked by almost 40%. Their once golden margins, which hovered around 14% not too long ago, shrank to just 8%. Now, on paper, that might still sound healthy compared to a mass market brand, but this is Porsche. 8% isn't strength, it's weakness. It's like a 911 Turbo suddenly running on 3-cylinder. Here's why it's such a crisis. Porsche has always lived and died by margins. They don't sell millions of cars like Toyota or Volkswagen. They don't have the luxury of making pennies per vehicle and relying on scale to keep the lights on. Porsche's business model is built on fat profits per unit. The Cayenne, the Macan, even the 911. These weren't just cars, they were ATM machines on wheels. Each sale padded the bottom line so much that Porsche could afford to take risks elsewhere. But when margins shrink, that entire model starts to wobble. Volume brands can weather a bad quarter because the sheer scale of their sales hides the cracks. Porsche doesn't have that safety net. Every single car they sell has to deliver a monster profit, and when it doesn't, the whole business suddenly looks a lot less bulletproof. That's the part hidden beneath the headlines. This isn't just a bad quarter, it's the foundation of their money-making strategy showing cracks for the first time in decades. And if you listen closely, you can almost hear investors grinding their teeth, because when Porsche isn't the high-margin king, it's just another luxury car maker trying to sell expensive toys in a world where toys are starting to lose their shine. Now let's talk about the supposed savior of the brand, electric cars. Porsche staked a huge chunk of its future on them. In fact, the Taycan was supposed to be the crown jewel, proof that Porsche could out Tesla. At first, it worked. The reviews were glowing. Early sales looked promising, and Porsche strutted like it had cracked the code. But fast forward to 2023 and 2024, and the shine is gone. Taycan sales fell nearly 50% year over year. That's not a stumble, that's the floor giving way. And then came the Macan EV. This was supposed to be the new Cayenne, the cash cow that kept profits flowing. Instead, it flopped on arrival. The reception was lukewarm, demand was underwhelming, and the decision to kill off the gas-powered Macan in Europe left loyal customers with no alternative. Porsche didn't just miss the mark, they erased their own safety net. But here's the twist that makes the story sting even more. Even when Porsche does manage to sell an EV, it hurts them financially. Unlike their gas-powered SUVs, which were rolling profit machines, the Taycan and Macan EV are expensive to build and less profitable to sell. Batteries, supply chains, and limited scale all eat into margins. Instead of being the new money printers, these EVs are quietly bleeding profits out of every showroom. That's the hidden crisis. Porsche didn't just gamble on customers being ready for EVs, they gambled on EVs being profitable. And the reality is harsh. Every Taycan sold today does the opposite of what a Cayenne once did. Instead of fattening margins, it trims them down. Instead of securing Porsche's financial future, it erodes it. The great EV pivot was supposed to be Porsche's masterstroke. Instead, it's turned into the mirage. It looks good from a distance, but disappears the closer you get. If the EV story is a mirage, the pricing story is a trap. One Porsche walked right into. Because here's the problem. When margins collapse, the most obvious fix is to raise your prices. On paper, it's simple math. If you're not making as much per car, just charge more for the car. And in fairness, Porsche has gotten away with this for years. The 911 climbed into six-figure territory so gradually that buyers almost didn't notice. The options list ballooned into second mortgages, and somehow customers kept ticking boxes. But 2024 feels different. The base 911 now starts well north of $130,000, and that's before a buyer adds anything fun. You want adaptive cruise control? Sure. Just fork over a small fortune. Paint to sample? Well, hope you've got a spare kidney lying around. Porsche is no longer sneaking price hikes in. It's shoving them in customers' faces. And then there's the dark side of the dealer network. ADMs, or additional dealer markups. Plain English, gouging. Tens of thousands of dollars added on top of already sky-high MSRPs. It's become so common that enthusiasts no longer feel special walking into Porsche dealerships. They feel exploited. Headlines about dealer markups have started to stick, and the tone has shifted from awe to irritation. Suddenly, being a Porsche buyer isn't glamorous, it feels like being conned. Here's the double-edged sword. Porsche needs those higher prices to keep margins afloat, but the higher they go, the louder the gouging complaints become, and the more they risk alienating the very enthusiasts who made the brand aspirational in the first place. That fragile sense of exclusivity, the idea that buying a Porsche was a privilege, is being replaced by the suspicion that Porsche is just bleeding customers dry just because it can. It's a dangerous game, because once people stop feeling lucky to own a Porsche and start feeling like they're being taken advantage of, the magic doesn't just fade, it evaporates. And in a market full of alternatives, that perception shift could end up costing far more than any margin hit. For years, China was Porsche's rocket fuel. It wasn't just their biggest single market, it was the engine that powered global growth. Stuttgart could count on China to soak up Cayennes, Panameras, and even the Taycan at full sticker price, no questions asked. In 2021, nearly 1 in 3 Porsches sold worldwide went to China. It was the market that made the whole global strategy work. But that engine has blown up. In 2023, Porsche's China sales collapsed by 28%, and in the first half of 2024, the numbers fell even further. This isn't a dip, this isn't cyclical, this is a cliff. The country that once underwrote Porsche's global expansion is now dragging it down. The brutal part is that Chinese luxury buyers haven't stopped spending, they've just stopped spending on Porsche. Instead, they're flocking to homegrown EV makers like BYD and Nio. These aren't cheap knockoffs anymore. They're cutting edge, packed with screens, smarter software, longer range, and often for half the price of a Taycan. For years, Porsche's advantage was prestige and profit per car. But when a local EV offers more tech, more features, and a lower price tag, suddenly Stuttgart's fat margins look more like fat baggage. Porsche didn't just lose a market. It lost the one market where customers would pay whatever it asked. And without China to keep margins cushy, the global model looks exposed. Europe is tightening, the US is grumbling about prices, and now China, the golden goose, has flown the coop. If you zoom out, it's even darker. Porsche isn't just battling Tesla anymore, it's battling a wave of Chinese automakers who move faster, build cheaper, and innovate at a pace that makes Porsche look, well, old. For a company that's built its reputation on always being a step ahead, finding itself 2 steps behind in its biggest market is more than embarrassing, it's existential. Now, if you want the clearest sign that Porsche is in trouble, just listen to their leadership. Not long ago, the company was pounding its chest about an all-electric future. 80% of sales will be electric by 2030. That was the pledge. Stuttgart was going to lead the luxury EV revolution and prove that heritage and batteries could coexist. But mid-2024 told a very different story. CEO Oliver Blume quietly admitted that no, the combustion engine isn't dead. Suddenly, the same company that promised to abandon gas is talking about extending the life of its internal combustion engine lineup, sprinkling in hybrids and hedging its bets. On the surface, that might look like flexibility, but in reality, it's damage control. Because here's the uncomfortable truth. EVs were supposed to replace Porsche's fat margins, and they haven't. Every Taycan and Macan EV sold has chipped away at profitability instead of boosting it. The old moneymakers, gas SUVs and the 911, are still doing the heavy lifting even as the company tries to bury them in glossy EV press releases. And hybrids, they're not a bold step forward, they're a band-aid. A way to stretch the combustion era a little bit longer while Stuttgart tries to figure out how to make EVs that don't bleed red ink. The U-turn isn't vision, it's survival. Porsche's grand EV roadmap was supposed to lead the company into a new era of profit. Instead, it's been rerouted back to the very engines they once declared obsolete. And that contradiction, the gap between the bold pledge and today's quiet backpedal, is the best proof yet that Porsche's real crisis isn't about technology, it's about money. So where does that leave us? Porsche isn't just a company with a profit problem, it's a brand fighting for its identity. For decades, Stuttgart had the rarest formula in the car business, a blend of soul and margin. The car stirred something in people, and the balance sheets were bulletproof. It was engineering magic, but it was also financial magic. That's what made Porsche untouchable. Now, both sides of that equation are under attack. EVs haven't delivered the profits they were supposed to. China, the growth engine, has blown up, and in the US, the pricing game is starting to feel like gouging instead of exclusivity. And the company's U-turn on its EV pledge shows just how shaky the roadmap really is. This isn't about whether Porsche can make a great electric car. It's about whether Porsche can still make cars that keep the brand's mystique alive and protect the monster profits that mystique has always depended on. Can they do it? Absolutely. This is still Porsche after all. When they focus, when they lean into what they do best, they're unstoppable. The GT and RS cars prove it. They still sell out instantly, still command loyalty, and still remind us of the magic. But the question now isn't whether Porsche can make magic, it's whether they can make it profitable again. They can still win, they can still turn this around, but only if they rediscover the thing that made Porsche a profit machine in the first place. Until then, the hidden crisis isn't going away, it's only getting louder and a lot less hidden.